This is one of the best videos in our 10-part limited video series about the market manifest and trading tactics and techniques that you can use to become a much better investor. Nothing in this video is intended as personalized trading advice for you, but you're going to really like this one, so stick with me. We're going to get to some good stuff. Resistance and support levels flip. You guys know what a support level is. You know what a resistance level is. Support level is when the stock keeps above that point, that price point, and anytime the share price approaches the support level, the trading volume picks up a bit and buyers come in and they start driving the price back higher. So it keeps bouncing off that level. It might be a round number level, especially with smaller stocks. A company is trading at $4 might have a support level at $3.50, and they break through that and go lower. Maybe there's a support level, the next one will be at $3 even. That applies to smaller, more thinly traded stocks. But regardless, if there's a support level, and a lot of times the opposite is a resistance level. The stock price has a hard time breaking through that price point. And a lot of times you'll see it bounce off that level. Maybe the stock goes up towards $4 and falls back from there. Goes up towards $4 and falls back from there. But eventually, it'll go again towards that level, hopefully. Maybe you own the shares, you bought them lower, and it breaks through that resistance level. That resistance level often flips and becomes a support level for a new higher range. So it breaks through $4, goes up to $5, $6, and it comes back down to the $4 level eventually 6 months from now, and it might have support at what used to be the resistance level. This video is inspired by the following testimonial that comes from Lana Wisman. I've been one of your lifetime subscribers for about 5 years, and although I do not bother you with my emails, I thoroughly enjoy receiving yours. I watch all your videos and have grown with your other products I've purchased throughout the years. As a retired medical worker, I just want to thank you for your recent posting on your multiple sclerosis adventures. It's wonderful to hear you laugh again and see you regaining your energy. Cut losses early. Hardest thing to do because you're actualizing a mistake you made. You thought that company's going to do well. You put in $1,000. Now it's worth $800. The hardest thing to do is to take your losses. Sell, actualize the loss, and say, okay, I did make a mistake. And that's why something like a stop loss strategy setup, like we talked about in this video series, would work out very, very well. Often, losses are painful to actualize. And if you don't, very often, the share price keeps on going down even lower, making the pain even worse. And a lot of times, if that and when that happens, and if you got out at a certain point and it dropped a lot more from there, you got out of the way of that decline, and you can take the money you have left over and reinvest it in that stock, which then will often recover and actually reward you from getting back to where it was in the first place, and the new shares you bought actually balloon in price. In that sense, cutting losses early is not only about cutting the losses, it's about setting yourself up for dramatic gains once the stock bottoms and you got out of the way of a speeding train. Let your gains run. A lot of newer investors will see the first 20% gain they've seen in a while, and so they sell their shares and they walk away feeling pretty good about themselves. But a lot of times, a stock will finally start showing some gains when it's just the beginning of a bigger move. Any move in a stock, you need to figure out why it moved like that. Was there a press release? Was there a change in governmental regulations? Was there new competition emerged or went bankrupt? Figure out why a stock's price moved, and you can look at the trading volume to see how much commitment there was among the traders. But avoid selling too soon. Maybe it goes up 20% in price and you don't believe the stock will keep on climbing. Maybe it's best to take profits. It depends situationally. But, as I said, newer investors are often, almost always, too quick to cash out, especially when you're dealing with smaller, lower priced stocks that have tremendous speculative value ahead of them. That's why when you see a stock and it goes up 1,000%, there's a whole bunch of people who sold when it went up 20%, 30%, 40%, the whole way. You want to be the one who holds on for the entire gain. And when you see that starting to wobble or change, and there's ways that you can learn from me and from my team about what to look for, how to know when to sell a stock. But when that starts fading or losing strength and you're watching the trading volume, it gives you another clue. Then maybe you want to take your profits after the entire gain was realized. Do not cash out at the first signs of profit. That's too soon in almost every case. And this video is not coming to an end yet because it continues right here. Click on that video. It'll continue right where we left off.